Sit back, relax, and let others do the hard work so that you can earn a passive income. Sounds too good to be true, right? Well, it isn't, and let me show you how. Hi guys, my name is Brandon, and in this video, I'm going to be showing you how you can earn a passive income by investing in dividend-paying stocks. Passive income is income that you generate from a source that you don't actually have to be actively involved in. You can actually think of it as money that's getting paid to you while you choose to do whatever the hell you want. To do this, you need money to begin with to invest. And the best thing about this type of investment is that you can start by as little as a few $100s. So once you have some money saved up, it's time to start investing. To properly understand dividend investing, first we need to understand what a dividend is. A dividend is a portion of a company's earnings every year that it pays out to its shareholders, and it's paid on a monthly, quarterly, or yearly basis. Now, there are two ways that dividend investors get rewarded. The first is this dividend income stream that gets paid out of the company's profits. The second is the capital appreciation of the company's stock value over time as well. These dividend payments will last as long as the company can sustain them, regardless of whether or not the stock price goes up or down, which is why it's really important to invest in companies that has really strong fundamentals. High dividend paying companies are generally not high growth. They don't spend most of their profits on R&D and expanding the business, but they give that value back to shareholders through the form of dividends. On the flip side, high growth companies such as Amazon, Facebook, Tesla, every dollar they make, they pump that money back into the company to continue expanding the business. But more about those companies in another video. Now, there are a lot of criteria that people use to evaluate dividend stocks, but I'll give you a general overview of some of the key things that I look for. Dividends are paid out of profits, so profitability is essential. If a company has what's known as an economic moat, competitors will find it very difficult to compete with this company in terms of price, which means the company's profit margins are very much sustainable. A moat may be in the form of intellectual property, brand value, patents that create a very high barrier of entry for competitors. So the wider the company's moat, the better ability that they have to maintain their profit margins and hence continue to pay your dividends and also grow them into the future as well. Another key metric to look at is the dividend payout ratio, which is essentially the portion of the company's profits it pays out in the form of dividends. Typically, a payout ratio of 30 to 40% is considered fairly safe, but it does depend on a case-to-case basis. Another key metric to look at is a good dividend yield. The dividend yield tells us how much we can make based on the market price of the stock at that point in time. And this is calculated based on the amount of dividend divided by the current stock price. So let's take a hypothetical company that pays a dividend yield of 5%. We invest $10,000 in that company today, and every year we would receive $500 in the form of a passive income from the dividends of the business itself. And this would be paid to us for the rest of our lives without doing a single thing, and you still hold the original $10,000 value that you invested into the company, which by right should be also increasing over time as well. A good dividend yield will vary depending on the industry the company operates in, current interest rates, as well as the economic conditions as well. But typically yields can range from anywhere between 1 to even 7-8%. The most common mistakes a lot of dividend investors make is just purely focusing on yield. Too high yields can also be a result of a massive drop in the stock's price and also represent structural problems with the business as well. In the long term and over time, it's much more effective to invest in strong, sustainable businesses that can maintain and grow a dividend as opposed to just purely chasing high yields. So if you can't be bothered studying individual stocks, another way to invest in dividend-paying stocks is through exchange-traded funds. Now ETFs are funds that can be purchased on the stock exchange that are designed to essentially track or replicate an index. Now, there are different types of indexes. Some can represent a specific type of asset class. Some can actually represent an entire country's economy. So buying an ETF is essentially buying a whole group of different companies that make up that index, and it's passively managed by the ETF fund just to track the index itself. Probably the best known index is the S&P 500, which is an index that represents the 500 biggest companies in the US. In Singapore, we have the Straits Times Index, which represents the 30 biggest companies on the SGX. And this index is made up of big blue chip companies like DBS, CapitaLand, and Singtel. The most popular Australian index is the ASX 200, which tracks the 200 biggest companies in Australia and is weighted by market capitalization. Another way to build passive income through investing in dividend stocks is to invest in what we know as listed investment companies. By investing in LICs, you're essentially investing in a team of professional investors that manage your funds on your behalf so that you don't have to make your own investment decisions. Each LIC will invest in different types of assets and have different investment strategies. Your job will be to look at their investment mandate and decide which one aligns with your investment goals as well. And a lot of these LICs actually focus on high yielding companies and paying out regular dividends to their shareholders. The investment approach of these funds vary from very conservative to very aggressive. While aggressive funds might promise you higher returns, they also carry with them a lot more higher risk as well. So you really need to consider the investing style of these LICs and also look at the underlying portfolio of stocks that they hold and decide whether or not these listed investment companies align with your own personal investing objectives. Another key thing to look at when investing in listed investment companies is the net asset value. The net asset value represents what the company holds in terms of assets like stocks minus all of its liabilities. It's important because you're buying these companies based on what they are investing in, so it's important to look at what those current values are. Another key thing to look at with listed investment companies is management fees as well as performance fees. As opposed to ETFs, which usually charge a very, very low management fee because they are a very passive instrument, listed investment companies often charge quite high management fees because it does involve active management. So you really need to look at how a listed investment company has performed in terms of their investments and decide whether or not that management fee and performance fee is worth paying for. Another way to build passive income through investing in dividend stocks is through real estate investment trusts. A real estate investment trust is a company that owns and usually operates income producing property. Now, these properties can range from office buildings to apartment buildings to warehouses to hospitals to shopping malls and even hotels. And one really big growth area for REITs at this point in time are data centers. Now, REITs are a great alternative to owning property directly. They have a very low initial investment, so you don't need to save up a huge deposit to buy just one property. Investing in one of these REITs gives you exposure to all the different properties that REIT holds. REITs have different investment strategies and different geographic coverages as well. So some will focus on one country, some will focus on a specific asset type across different countries. Now, I personally love investing in REITs because they have that underlying asset of a physical property, and rental income is usually a little bit more stable and reliant than relying on the profits that a company generates. And it's also kind of cool, for example, if you invest in a retail REIT and you go to a shopping mall and you can actually say to yourself, you own a little tiny piece of this property. REITs typically yield a little bit higher because they have a very high payout ratio, and they can range anywhere between 3.5% to 7, 8, 9%. Income investing with dividends is just one way to generate a passive income, but it's probably the most easiest one to get started. And the time that you spend investing in this income portfolio can be really, really rewarding in the future, especially with the effects of compounding and reinvesting those dividends to continually grow that asset base. Now, a quick disclaimer, this is not a financial advice. I'm just laying out the options for you. Don't be lazy, do your own homework, and I'm just sharing some of my own personal investment strategies to build this form of passive income. Depending on your own circumstances, you may want to balance out this income-oriented portfolio with a more growth-oriented portfolio. This is what I've done personally, but more about that in a future video. So if you like this video or found it useful in any way, please again, hit that like button. It'll really help me, and also subscribe to my channel and come along on this income generating financial adventure that I'm going on, and would love to have you with me. In future videos, I'll share more about my own personal income portfolio and how I've been able to build that up to actually generate me about $500 a month in terms of passive income. But until next time, see you guys.